Hello and welcome to another episode of Selling Greenville. I'm your host, Stan McCune, realtor here in Greenville, South Carolina. We are doing episode 51 this week, 51 episodes. We had a fun little episode last week, 50, with some lessons that I've learned. It coincided with my 5th anniversary in real estate, which actually I downplayed that how closely the timing was to my 35th birthday, which happened last week. But actually, I found out that my 5th anniversary with Sedan Joyner Realtors, which is the company I've been with the entire time I've been a realtor, that actually did happen last week. So a lot of things happened last week. I was very excited about that. This week, we're going to be talking about timing the market in today's episodes, timing the real estate market. But before we get into that, a little bit of housekeeping, as we always do. Please go ahead and give the show a rating or a review if you've not already done that. Please go ahead and subscribe to make sure you don't miss future episodes. And if you need a realtor, or if you just want to shoot the breeze with me, discuss some ideas, discuss this podcast, all of my contact information is in the show notes. I will reply to everyone that reaches out to me. If you don't hear from me, it probably means you've perhaps sent me an email that went into my spam or something like that. Please make sure that you reach out to me. I respond to everyone at all times. I was actually on vacation last week. I got multiple clients under contract while I was on vacation. I was setting up showings. Yes, I have systems in place to make sure that even when I'm out of town, I can still help my clients. That is the way I roll. I'm not the type of person to turn off my phone and just decide, you know what, people are just going to have to live without me. Listen, real estate is a 24/7 business. I get that, and I embrace that, and that's just the way it works. And of course, I enjoy what I do, which helps quite a bit. But we're talking about, aside from the fact that all of my contact information is in the show notes, you're here listening because you want to hear about timing the market, right? And this is a question that I get from time to time usually from novice investors, but also from people that haven't bought and sold a lot of properties. And occasionally I'll hear it from someone who is pretty savvy, but is perhaps trying to be a little bit savvier than they should be. How to time the real estate market. Specifically, how can we buy low and then sell high? And typically when people talk in those terms, they are trying to approach the real estate market similarly to how the stock market works. Now, I always have to be careful when I have this discussion or when I talk about these types of things because I am not a financial counselor, a financial planner. I can't assist you with that. Legally, I cannot assist you with financial planning. Don't ask me, hey, what's my best strategy? Should I keep this money in a 401k or should I invest it in real estate? I'm sorry, I can't do that. There are professionals out there that are licensed that can do that. That's not what I'm going to do. And so I will hedge what I'm about to say with that. I'm not a financial planner. Talk to your financial planner, your financial advisor for specifics on your strategy. But I can say this, in my experience, there is a major difference between purchasing real estate. And now I understand there's a lot of different models for purchasing real estate, and there are some models that are similar to the stock market. I'm talking about actually buying a property in one way or another. There is a difference between buying property and how that works versus buying ownership in a company, buying stocks on the stock market. And the primary difference, at least in terms of this discussion, is that a house value, a property value, cannot artificially grow or plummet in value overnight in the same way that stocks can, outside of some really, really major macroeconomic event happening, such as, like a war, for instance. Like if we had a Pearl Harbor type of situation, then that would impact real estate, right? That would impact real estate overnight. But outside of something like that, or outside of a recession that is directly tied into real estate, that's what we had in 2008, 2009, and several years following. That was a real estate recession. That was because of what lenders were doing, specifically with regard to mortgages and mortgage-backed securities and all of that. We've talked about that in the past. That was a real estate recession. We had a little recession in 2020 thanks to COVID. That did not hurt real estate. Yes, we saw an immediate, somewhat of an immediate response in March where things slowed down for a couple of weeks and then it immediately bounced back up. And pretty much every real estate company had record years in 2020 here in the upstate. So even though 2020 experienced a bit of a recession, it did not impact real estate. Real estate is different when it comes to recessions and when it comes to these types of macroeconomic things versus stocks. Stocks can, as anyone knows, stocks fluctuate on a day-to-day basis. This is why you have day traders, why people are big into day trading. Some people make a lot of money doing that. Some people lose a lot of money doing that. I have no idea. I don't know anything about day trading. So again, I'm not a financial advisor and I don't do day trading. Maybe I should, maybe I shouldn't. I don't know. I understand real estate. That's what I do well. So I try to double down on what I do well rather than dabbling in a bunch of things poorly. But I do know, I remember this just because it's kind of a funny thing. And I listen to the Joe Rogan Experience podcast every now and then. It's long, so it's good for a nice long drive. And I listened recently to, we're recording this in the middle of February of 2021. He just re-interviewed Elon Musk, who he's interviewed in the past. And they shared a little bit of a joke as they, busted out some alcohol. I don't know if it was bourbon or whiskey or something. And Joe Rogan joked with Elon about how in a previous episode, they had smoked marijuana on Joe Rogan's stage there. Well, when that happened, immediately Tesla stock started plunging. People, I don't know why. I don't know why people thought, maybe they thought that Elon Musk was going to go to jail for that. I mean, listen, a guy like Elon Musk is not going to go to jail because he puffed, some weed. That's simply not going to happen. But that's the volatility that you have in the stock market. The dude on a podcast, which of course they do have video that they air of it, but he just took a little puff of a drug that is, technically illegal in a lot of places, or technically a banned substance in a lot of places. And because of that, his company stocks dropped immediately. And smart people at that moment went and bought a bunch of Tesla stocks and made a lot of money. Well, listen, that is not what happens in real estate. That is not the way the real estate market is. So you can't take that same buy low, sell high approach in real estate. It doesn't work. Things take usually a lot more time in real estate for the market to adjust. You don't see instantaneous adjustments. You don't see overnight adjustments outside of very unusual, like once or twice in a lifetime type of events. Like we've already talked about, like a Pearl Harbor type of event, like a Great Recession type of event. But even if you look at the Great Recession that happened in 2008, 2009, yes, that was when it hit, right? The Great Recession started around that time period. But here in the upstate, we didn't really see the real estate market completely bottom out until probably around 2011. There are a few different ways to look at that, but I would argue, just based on the data that I've looked at, it was probably around 2000, towards the middle to the end of 2011. So it was years. If you really wanted to buy at the bottom of the market, that wasn't in 2009. That was actually more in this area, at least in the Greenville, upstate South Carolina area, around 2011. So again, it's not apples to apples. We have to be careful with timing the market. And here, if you're wondering where I'm going with this, I am going to caution you against timing the market in real estate. I don't like it when people try to time the market. I don't think it's fruitful. But I do have some ideas about how to think about it in more of an appropriate way from a real estate standpoint. And the way I think about it, I'm not trying to time the market to buy low and sell high. That's really difficult from the standpoint of waiting for the market to flip, right? We're in a seller's market. We've been in a seller's market for a really long time. If you are waiting for a buyer's market to come around so that you can start to buy low and then hold on to it for when it flips back to a seller's market and then sell high, you could be waiting a long time and then for the buyer's market to come around, and then you're probably going to sell much sooner than you should theoretically for the seller's market to come around. I mean, I thought it was a crazy seller's market just a few years ago, and 2020 just completely blew everything out of the water. One of my early clients in 2020, when COVID was happening, right at the very beginning, in March, was like, hey, is this about to flip to a buyer's market? And I was like, we didn't know what was going to happen. I was like, I don't think so. I don't see that happening. And you can listen to, it was around that time that this podcast started. You can listen to some of those early episodes where I was perhaps working out some of the kinks of my audio and whatnot. But you can listen to some of the early episodes of this podcast where I discussed, I don't really think that this is going to flip to a buyer's market. Not only did it not flip to a buyer's market, it doubled down on a seller's market, which was driven, as we've discussed in the past, a lot by what happened, when the Fed made changes that resulted in mortgage rates going down. So again, it's very difficult to time the market on a macro level. A better approach when it comes to real estate is to think about the market, the real estate market, in terms of trends, specifically in terms of trends like appreciation. Now, we talk about home value, property value appreciation a lot on this podcast because that is a very, very important consideration. That is a very, very important factor. The reason why in the U.S., a lot of people, their most valuable asset is their house is because there is this assumption that their home value is going to appreciate. Now, there are some parts of the country, a lot of parts of the country, where homes do not appreciate at the level of inflation or greater than other ways that you can invest that money. In the upstate, we have been blessed, at least since 2011, 2012, home values have appreciated in a lot of areas and at a lot of price points much better than even a lot of other options in the stock market and whatnot. Things that you can do with your money in terms of stock trading, in terms of 401ks and whatnot. For a lot of people, their home values are out appreciating those things. And for sure, their homes are out appreciating the inflation rates almost across the board. We talked about that. There was an episode way back when, I don't even remember the episode number, but there was an episode that I did that really got into the nitty gritty on home value appreciation, where we tracked the median price point for different homes. And some of them were appreciating in some areas 15 to 20% per year, which is crazy. But that's not out of the question for this area. And again, I'm not going to rehash all of that. We talked about that. But everyone wants to know, right, as part of this whole buy low, sell high conversation, everyone wants to know what the next big area in the upstate is going to be from the standpoint of exponential appreciation. So we know that the upstate, is appreciating well. If you want to buy a home in the east side of Greenville, you're probably going to see annually 5 to 10% appreciation, like pretty consistently. But what are the areas that are like really up and coming, where we're going to see more of those 15 to 20% rates of appreciation in home values, and where you can, buy a home really cheap now, but then sell it for 3 or 4 times what you bought it for this year, sell it for 3 or 4 times that in just a few years, where you might actually see, even significantly greater than 15 to 20% appreciation. Well, again, that's hard to predict. at the end of the day. Now, we know that there are some depressed areas that seem likely to improve in the future. When I say depressed, I just mean areas where homes, you see a much larger percentage of homes that need significant repairs, properties where there are landlords that aren't updating their houses, properties that have been in a family for a really long time, they've been vacant for 20 years. There are several areas like that, and you can kind of reverse engineer which areas are the ones that are likely to at some point improve in the near future, just based on their location. If they're close to downtown Greenville in one way or another, or close to other areas that are being revitalized, then they will probably at some point flip to some type of exponential appreciation. So, some areas that come to mind are the Donaldson Center area, the Poe Mill area of Greenville. There are actually parts of Overbrook that I would consider, that would fit that description. Parts of the White Horse Road corridor. And you might even consider some parts of Malden and some parts of Taylor's in there. Taylor's is an interesting one. Well, Malden as well. There are a lot of homes there that, people moved in them, 40 years ago when they were in their 40s or 50s. And now, those people are getting older. They're starting to sell them off. They haven't been able to do updates to those homes in a very long time. And now they're starting to get sold. And now those areas are starting to, that already aren't bad areas, but they're starting to be revitalized, even in spite of that, to kind of take that next leap. So we can read the tea leaves on some of those things. We can, read the tea leaves by looking at, what areas are getting the most amount of money dumped into them, whether that's money from the city or the county or the state, money from developers, what areas have predominantly absentee owners in them. Some of these things can help us to identify what those next up and coming areas are. But at the end of the day, again, is that really necessary? I would argue that there can be some value in that. There's certainly some value in that. I own a property in the Poe Mill area that I think will be extremely valuable in years to come. And it's doing fine as a rental property. I could probably sell it and make a good bit of money versus what I bought it for a few years ago. But why would I? I feel like that's an up and coming area at some point down the road. So there is some value in that if you're planning to hold on to something for a really long time. But I don't think it's really necessary, and in a lot of ways, it might not even be feasible. Again, to try to time the market, and from not just from the standpoint of the macro market, how is the macro real estate market going, but trying to time the market in terms of identifying those areas, those high upside areas that are really cheap right now. I mean, it's pretty obvious. You can find pretty easily the areas where homes in Greenville County are selling cheaply. If that's your strategy, if you just want to roll the dice with just buying cheap properties and waiting for exponential appreciation to happen to them, it's not hard to figure out what those areas are. But we already know in general that the upstate as a whole, regardless of those areas, appreciates consistently over time. We already discussed that even in this episode. And again, you can go back and listen to my episode where I specifically dealt with appreciation. But in my opinion, the way to buy low isn't to try to time the market or to try to just buy those cheap areas that are perhaps depressed and are going to appreciate over time. But instead, you need to identify what the opportunities are right now. There are opportunities right now in this market that don't just involve you purchasing the cheapest possible properties in the areas that may appreciate exponentially in the future. Obviously, there are always opportunities out there, people that are selling below the market for one reason or another. I always tell people when, for instance, a multifamily property comes on the market, almost always there is something wrong with it. Almost always. because people don't typically sell multifamily in our area. There's got to be something wrong with it. It either needs work done on it, or it's got a tenant that is causing issues, or whatever the case may be. And so those can be opportunities, what we might call value add opportunities, where you can purchase something below the market, improve it, and see greater appreciation in that property than what you invest into it. There's always people out there. This is, we talked about in previous episodes about wholesalers. Wholesalers specialize in identifying motivated sellers, people that don't want to go through the whole process of listing their home on the open market. They just want to have a smooth, easy transaction. They're willing to sell the house for much less than what they could sell it for on the open market, because they get something in return, a smooth transaction, something that they don't have to manage and worry about. They don't have to clean the home for showings, et cetera, et cetera. Additionally, I think that it's important to accept that, at least for the immediate future, I think the values of the upstate will continue to appreciate. There's no reason to think that values won't appreciate the way they have in the past, because that's being driven by supply and demand. And demand's not going away anytime soon. We have plenty of people wanting to move to the upstate of South Carolina, and the people that are here, they're by and large not looking to leave. And supply, we do see more developers, more builders trying to pull out permits to build in this area. But we've got a long way to go before there's going to be more supply. We need a lot more supply. We've talked about the housing affordability crisis in this area. We need those builders way more than what we currently have lined up. So all that to say, I don't see any major risk in appreciation dropping off anytime soon. And so that means that it's less important to try to time the market. You try to time the market when you're unsure of the future. You need to be very careful. Okay, I've got to be very careful that I buy low so that I can sell high. We're in a market here where all indications are that as long as you don't buy extremely high, if you buy where the market is, you should be doing fine several years from now, as the market just continues to appreciate at its normal rate. Another consideration, of course, when you're trying to time these things, and this is a little bit more of a timing-based thing, is mortgage interest rates. Now, we've talked about this as well on several episodes, but they have been for several months now at historically low rates. Again, we're here in the middle of February 21. Mortgage interest rates are ridiculously low, and it's a good bet that they will never go lower, and may never go back down to these levels again. I would be shocked to ever see 30-year loans go below 3%. Again, it's possible. We are in very strange times in terms of how the government acts, but it would be surprising to me. It's definitely a historical anomaly. And so that can be a good indicator when to buy as well. If you're able to buy a property that you're planning to hold for a long time and you get a ridiculously low interest rate, then you're able to buy more home for less money. It's very simple, and you're able to keep that interest rate for as long as you have that house and as long as you have that loan. That's a great way to invest your money, in my opinion, as a non-financial counselor. Now, some, of course, will mention that when mortgage rates are low, usually prices go up, the prices for homes, as the market kind of balances out. And that's true to an extent. But here's the thing. We need to caution on that way of thinking, because different parts of the country have different real estate markets. And what we've seen here in the upstate is that while that is true, we did see prices really go up last year when interest rates went down. But what we haven't seen is, as interest rates creep back up, which up until last year during COVID, they had been creeping quite a bit up from the previous time that they had bottomed out. We don't see prices go down. And again, it's a supply and demand thing. So what I don't expect is, okay, so prices went up in 2020 due to very low mortgage rates. Presumably those mortgage rates will go up as this year goes on. We're not going to see prices go down. We should not expect that. There is no data to indicate that the cost of housing will lower as mortgage interest rates go up. That would be an extreme historical anomaly for the upstate. Nobody is predicting that that's going to happen. You can expect that prices are going to continue to go up regardless of what happens with mortgage interest rates. It's just that when rates are low, those prices are going to go up a little bit faster than they normally would. But in general, a home that you can buy right now in February of 2021 is going to cost you less than it will cost in February of 2022. So if you can get it for less than you would next year, and you can get a low mortgage rate, do the math yourself. To me, in most instances, if you're looking to make a purchase, whether as an investor or whether as an owner-occupant, sooner is going to be better than later, generally speaking. Of course, everyone's situation is different. If you want to discuss your situation in more detail, obviously, that's where you can reach out to me with my contact information. That's in the show notes. But I would just say this. If you're in real estate in the upstate for the long haul, whether it's as an investor, whether it's as an owner-occupant, you really don't have a lot of value in attempting to wait for the market to flip, to try to time the market. Because you're probably, again, we've talked about this a little bit, but you're going to end up waiting for a really long time. You're probably going to end up buying too soon. You're not going to buy when the market has bottomed out. You're going to see the market flip to a buyer's market and immediately start to buy. And then when it flips back to a seller's market, you're going to immediately start to sell, and you'll never buy at the lowest point of the buyer's market, and you'll never sell at the highest point of the seller's market. It is very, very challenging to predict those things on a real estate level. It's much more challenging, in my opinion, than it is when it comes to the stock market. There are clearer indicators of when it comes to company stocks than there are when it comes to houses. A better option, in my opinion, is to take advantage of the opportunities in front of you. Is there a good opportunity? Whether it is a good investment, whether it is a good house for your family, take advantage of that. There's no virtue. There is almost certainly not going to be any value. You're not going to win out by waiting. And you can be confident, almost certainly, based on the data that's out there, that the property that you purchase, as long as you don't overspend, it will end up being a good investment. And again, as a realtor, I try to help my clients to make sure that they don't overspend. I'm very honest. I spend more time talking my clients out of purchasing properties than I spend trying to talk them into it. That's the way I run my business. I try to be as transparent and as honest as possible. I feel like that's the best way for me to do business. I think another consideration is this, and this is particularly for owner-occupants. It's that the market often appreciates linearly, okay? In other words, we don't see homes that are in this price point up to a certain price, but let's just call them middle-class homes. We don't see more expensive middle-class homes appreciating at a lesser rate than cheaper middle-class homes. Generally, it appreciates kind of in the same straight line. Like, for instance, if $200,000 homes are appreciating at about 10% in a given year, probably $300,000 homes are also appreciating at around the same rate. And what I hear frequently is people will say, well, you know what? This market is too crazy right now. I'm going to wait for this market to settle down before I move, for instance. I mean, obviously, I work with a lot of investors as well, but let's talk about owner-occupants. I've heard some people say, you know what? I want to move. We're going to move in the next few years, but I want to wait until this market settles down. This is just too crazy. I'm not going to get into bidding wars. I'm not going to, deal with all these situations where there's highest and best offers, all this crazy stuff. I'm just going to let the market settle down a little bit. And you know what? I've got a home that I have to sell. And even though next year, the homes that, if the market settles down, the homes that I'll be looking at will have grown in value. My home also will have grown in value. Well, here's the problem with that. If you're moving into a more expensive home, or if you're an investor and you're looking to sell a cheaper investment to buy a more expensive one, you're going to end up spending more and paying more by waiting. Because if you've got a $200,000 home that appreciates by 10%, then over the course of a year, then it appreciates $20,000 versus if you're looking to buy a $350,000 home that you would move into, that's going to appreciate by $35,000. And so you'll end up losing $15,000 by waiting. Again, every situation is different, but most of the time, people tend to not think logically when it comes to deciding whether to wait to purchase or to make some type of a real estate acquisition versus doing it now. Odds are, generally speaking, if you think that you're going to make some type of real estate purchase in the next year, it makes more sense to do that sooner than later. And I'm not just saying that because I want more closings. I promise you, that is not why I'm saying it. This is how I practice my business. Because you guys know, if you've listened to other podcasts, that I also invest in real estate. And I jump on the opportunities when they arise. I don't say, you know what, I'm just gonna wait. This is too crazy. Yeah, the market's nuts right now. Okay, but that doesn't mean that I'm just gonna wait for it to settle down. That doesn't make any sense. There are opportunities right now, and that's what I truly believe that everyone needs to understand and needs to recognize, that there are always opportunities right now to consider. And maybe a bidding war doesn't feel nice. Maybe that's, it's frustrating to try to purchase several homes and to end up losing out on them because of the bidding war types of situations. And, me as a realtor, I don't like spending time writing a bunch of offers that end up getting rejected because it's just a crazy market right now. But that's just the way it is. That is the way the market is right now, and we don't have any indication that that's going to really change anytime soon. And in the absence of that, I think that we need to push forward and deal with the yucky feelings of having offers rejected. That's what I have to do as a realtor. And I put in a ton of offers on investment properties that I've been outbid on as well. It's just the way it works. It's like fishing. You put your line out there. You just need to get one fish to bite on it, and a bunch of them will pass by the line, but you only need that one. And that's the way it works. That's what we're looking for. But trying to wait it out and trying to time it and trying to say, let's just wait until the market calms down, settles down. You're gonna be waiting for a while. And you're going to find that home prices, that property prices, that investment property prices, by the time you finally determine that the market has slowed down to your liking, now the market is going to be way more expensive. And so you have to pick your poison. The poison that I pick and what I recommend is to go for the opportunities now and just understand that it is a seller's market, is a wild market. You have to take that into consideration and just move forward with putting your best shot in there, with taking it seriously, with not lowballing offers, because you can't do that in a seller's market typically. And if you can, I'll let you know. I did have some clients that we were able to get some lowball offers under contract last year despite the crazy market. There are some opportunities like that, and I can help to identify that. And that's where I come into the equation, right? I'm able to help identify where the opportunities are. I'm able to help you to not have to time the market. That is a lot of the value of what I tried to bring as a realtor, is so that You don't have to be like, okay, well, when is the right time to strike? Well, there may always be the right time to strike is when the right time to strike is when the property that fits your criteria comes on the market. For some people, I have that discussion where it's just like, you know what you're looking for, and at the price point that you're looking for you're not going to find that. So maybe you just need to decide, hey, we're just not going to buy that investment property that doesn't exist. We're not going to buy that new house. It doesn't exist. Sometimes that is just the reality of the situation, and those people, they might find themselves stuck, in paralysis, whatever the phrase is. They might find themselves being frozen because they don't know what to do. They can't figure out whether to pay more than what they feel comfortable paying, because that's what they have to do in order to get the property that they want, or to just wait it out, which is a fool's errand, because properties are going to keep going up in value. Again, where I come into the equation is that I can help to identify the opportunities and to help filter things and to give you an honest, as much as I can, non-biased assessment on where the market is and how that fits into what you're looking to do, whether it's add to your rental portfolio or whatever the case may be. So if you're in the market for anything, let me know. All my contact information, once again, is in the show notes. I'm happy to help you guys out with anything. Let me know. I hope you guys stay safe and have a good rest of the week.